want to buy individual stocks, buy, you need to know what you own. That is at the core of my philosophy. If you don't want to put in the work to understand how these companies actually make their money, you're better off investing in an index fund. Which brings me to the cloud-based software space. This is one of my favorite secular growth stories, and it's produced some spectacular gains in recent years. But unfortunately, when I see you on the street and they say, well, Jim, what's got the mojo, what's going up, what are the wide receivers of the stock business? The cloud stocks, they're tough to understand. That's why last night we started a new series, a Cloud Cramer, where I'm trying to explain all of these companies, and I'm using plain English. And then we're going to put them all together into an ETF that we'll use to gauge the performance of the industry. We're going to set up the ETF ourselves. And you know what? We don't want all those fees that everybody else gets. We just want to help. Now, we already covered the cloud plays that have reported this earnings season. So tonight we're pivoting to the ones that are still coming up. So let's tick them down because there's some really great ones. The first one you just heard is Cramer fave Salesforce. That's a company that practically pretty much pioneered the whole cloud-based software as a service business model, and it's still at the forefront of the industry, still winning gigantic contracts, still digitizing whole swaths of business, as Keith Block, the co-CEO, talked about on his conference call tonight. Salesforce got its start with a customer relationship management platform, helping the clients understand and connect with their own customers. Okay, retention. Over the years, they've expanded into all sorts of areas like marketing, automation, analytics, and software development. At this point, it's become kind of a one-stop shop that tonight's quarter shows, well, the company's pulling away from its competition. Second, there's VMware, which is a major player in what's known as virtualization. This technology is integral to the modern data center. Basically, VMware's platform allows a single physical server to run multiple virtual machines. So multiple users can use the same computer at the same time. On top of that, the company acts as a kind of a consultant for businesses that are looking to migrate to the cloud. Once you make that switch, they'll help clients make sure everything's running smoothly and even provide security. They have a great relationship with Amazon. The one problem with VMware is that it's a subsidiary of Dell, not the parent, but the sub. And earlier this month, we learned that the company was being, let's say, encouraged to buy another Dell subsidiary, Pivotal Software. The stock has been slammed since then. And then just look at what happened tonight. VMware reported a strong quarter, a healthy top and bottom line beat. But the stock got clobbered when the company announced that not only are they buying Pivotal, they're also buying Carbon Black. That's a cloud-native security play for $2.1 billion. Me, I like the cloud security space, and I'm going to say buy VMware on weakness. The stock's come down too much. Third, you got one that was up huge today, Workday, WDAY, that makes software for human resources management and finance departments. In plain English, Workday lets businesses automate a lot of back-office functions related to talent management, to recruiting and financial modeling, and a bunch of additional ancillary areas. They've got a student platform that's used by colleges. The company reports in 6 days, and for once, it's got a nice setup. That, thanks to a recent market-wide meltdown, Workday pulled back dramatically from its highs. Even though the story hasn't really changed. Look, I'm a big believer in this one, and I think that you can buy Workday right now, although obviously it was up so much today. Maybe it comes off Monday a little bit. The fourth cloud king you haven't heard of yet, well, probably maybe have. It's Adobe. This is one of the easier names to get your head around. You probably use their document management or creative cloud products. Think Adobe Acrobat or Photoshop. A few years ago, the company switched to a cloud-based software as a service business model. Lately, they've also been expanding into marketing and analytics in a very big way. If you want to set up a gorgeous website to attract customers, well, you got to have Adobe. I've tried it. Now, these guys probably won't report until mid-September, but their last quarter was truly excellent, even if the guidance was thought to be a little light by some, not me. Over the past month, though, the stock has pulled back from 313 to 287. I don't have a read on next quarter, but with Adobe trading at 30 times next year's earnings estimates, I think it's a bargain given its phenomenal growth rate and its amazing management. You can buy some here, and then, tomorrow buy some. And if it goes lower, you can buy more. How about the smaller cloud princes? Okay, one that it's a Cramer family fave, frankly. It's called Okta. And this has been one of the hottest stocks on the planet for the last couple of years. Okta calls itself an independent provider of identity for the enterprise. That sounds like a lot of authentic Silicon Valley gibberish in English. What it really means is they will protect everything. They handle your login, your verification credentials, your usernames, your passwords, your mother's name, maiden name, and so on. They help protect businesses from hackers. I think everyone on earth right now would like to be protected by Okta. They want their, consider it, they protect your passport, okay? Okta reports next Wednesday, and I'm confident they'll deliver yet another great quarter. However, the stock is down, only down $8 from its highs, and therefore it's pretty expensive. As much as I love Okta, I am going to recommend waiting for a pullback before you pull the trigger. And I was very sensitive on Twitter. I got a couple of comments just today saying, Jim, you always say wait for a pullback. What's the deal? Why don't you just say buy? Well, I'm highlighting companies, and they're on the run. And I have to be careful. Second Cloud Prince is Coupa Software is a company that helps other businesses identify cost savings that refer to themselves as Salesforce of expense management. Their platform gives businesses better visibility into where the payments are going and allows them to have more control of that. Plus, it lets you automate jobs in your accounts payable department. We won't hear from Coupa until September 3rd. Like Okta's got a fabulous track record. And like Okta, it still hasn't really come down. At these levels, I don't like the risk word, but put it on your shopping list. Beyond the cloud royalty, there are a few more names worth considering. Veeva Systems, what a stock. It's got a very special niche, makes software for life sciences industry. Veeva helps its clients manage R&D. Think records of drug trials. They handle regulatory compliance, and they help manage commercial business, processes. A lot of this data is extremely sensitive, and Veeva does a great job keeping it safe. Now, Veeva's chart is a thing of beauty. This stock is up nearly 80% for the year, but it's still down about 10% from its highs last month, thanks to the market-wide sell-off. So I think you're okay. You're getting a rare chance, frankly, to buy Veeva at a discount. Take it. Then there's Anaplan, which is not actually an anagram, right, if you have Anaplan and Canal, but Anaplan is in the financial planning and analysis business. Nearly every major enterprise will have what's called FP&A group as part of a finance department. They're in charge of forecasting the company's performance in the future. Anaplan gives these guys the tools they need to forecast accurately and do it quickly enough, great management here, by the way, that people calling the shots can respond in real time. We hear from Anaplan next Tuesday. I hope to talk to them personally. And this is another case where I'm expecting good things. But with the stock up more than 120% for the year, but not that we didn't tell you about that, it might need to cool off. We were behind Anaplan from the get-go. Next, you've got Smartsheet, not talked about on the show. Their platform is like a cross between Microsoft Excel and Google Docs. Basically, people use Smartsheet to keep track of big data sets. But it's not just Excel on steroids. It's also about collaborative project planning. These guys report next month. I think you have to be careful because Smartsheet is only down about $4 from its highs. Finally, Zscaler. This is another cloud-based security software play that we like so much. As more applications move to the cloud, the previous generation of cybersecurity platforms can't really keep up with the volume of data that's being created by these programs, so they can't provide consistent protection. Old-school cybersecurities were designed around an on-premise software. Everybody's working in the same building. Let's build a firewall, right? Zscaler helps secure all your network traffic, no matter where it comes from. They do web security, advanced threat protection, data loss prevention, and they have their own next-generation firewall. All of it delivered 100% on the cloud. Kind of like CrowdStrike. These guys report on September 10th, and thanks to the recent sell-off, the stock has pulled back from 89 from its recent highs to 72 right now. In part, that's because Zscaler got hit with a negative report from a boutique investment firm. Their channel checks were weaker than expected. I don't buy that. We've been told, it doesn't make sense to me. The old guard in the cybersecurity space that Zscaler is eating their lunch, and I think it's worth buying into the quarter. Buy. Zscaler. The bottom line, I know the cloud stuff can be pretty darn dense. That's why we did this piece, and a lot of you stopped me in the street and told me you like it. These stocks, I know, they're sexy. They cannot be ignored. You just have to know what the heck you're buying before you pull the trigger. Once you have that knowledge, you have got my blessing, literally, to bet on the cloud stocks, but please don't bet on the ones that just ran. We don't chase on Mad Money. Horatio in California. Horatio!
Booyah, Mr. Cramer.
Booyah.
I'm a first-time caller.
Okay.
My question is, why did Symantec stock not jump in price when the deal was reached that Broadcom would be buying part of Symantec's business?
Great question.
And a $12 dividend was going to be paid out.
But that's a great question, because what happened is that Symantec's still going to have the B2C, we call it, the business to consumer business. I don't think people realize how good that business is. I would buy Symantec. It's run by Rick Hill. Rick Hill's money. Get your head out of the darn cloud. but make sure you know what you're buying if you buy any of these stocks. Much more Mad Money ahead. Now that the dust is settled and panic subsided, it's time to circle back to high growth stocks. I'm talking with the CEO of Talon to see if it's worth taking a closer look. Then, what's going on in the oil patch? I'm telling you why this sector just can't catch a break. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.